is found at the beginning of the policy. The privilege of change clause, or policy change provision, outlines the conditions under which the company will allow the policy owner to change the policy's coverage. The insuring clause or agreement sets forth the company's basic promise to pay benefits upon the insured's death and specifies the amount and frequency of premium payments. The execution clause or provision specifies that after a certain period of time has elapsed, usually 2 years from the issue date, the insurer no longer has the right to contest the validity of the insurance policy so long as the contract continues in force. The incontestable clause allows an insurer to contest a claim during the contestable period. However, statements related to age and sex or gender can be contested at any time. The company reserves the right to the premium adjust if the age of the insured is misstated. Death caused by suicide is excluded during the initial period of time after the policy becomes effective. Owner's provision or rights of policy ownership states that the policy owner possesses all rights contained in the policy. The primary rights of a policy owner include the right to assign and change the policy's beneficiaries, the right to determine how proceeds will be paid, settlement options, the right to terminate the policy and select a non-forfeiture option, the right to determine and change the premium payment schedule. Not necessarily the amount of the premium, but whether the premium is paid monthly, quarterly, annually, etc. The right to assign ownership of the policy to someone else. The right to decide what happens with dividends paid out from a participating policy. The right to convert or renew a term policy if such option exists within the contract. Absolute assignment of an insurance policy involves a complete transfer of the policy to another. Beneficiaries and assignees are entitled to the proceeds upon the death of the insured before any claims of the insured's creditors. Irrevocable beneficiary means the beneficiary cannot be changed. There are 2 types of assignments: absolute and collateral. Mode of premium states that premiums must be paid to an insurer or its representative in order for coverage to be provided and allows the policy owner to select the mode of premium. Free look provision allows the policy owner to return the policy for a full premium refund without giving a reason to the insurer. The grace period in a life insurance policy is meant to protect the policy owner against the unintentional lapse of the policy. The reinstatement period allows an insured to reinstate a lapsed insurance policy. Typically, this must be done within 3 years of the policy lapse, but in some state, may be allowed as long as 7 years. If the insurer does not accept or reject the reinstatement within 45 days, coverage will be automatically reinstated as if it had never lapsed. Non-forfeiture options prevent the policy owner from forfeiting a policy's cash value if they decide to terminate the policy. There are 3 non-forfeiture options: cash surrender, reduced paid-up option, and extended term option. The cost recovery rule states that when a life policy is surrendered for its cash value, the cost basis, total premiums paid, is exempt from taxation. The extended term insurance option provides the insured with the most life insurance protection in the event of a voluntary policy surrender or non-payment of premium. The primary advantage of a policy loan is that it provides ready cash for the policy owner without having to apply or qualify for the loan. The automatic premium loan provision allows the insurance company to automatically take a loan against the policy's cash value to pay the premium due if the required premium is not paid by the end of the grace period. The spendthrift clause stipulates that a settlement option may be selected by the policy owner at the time of application. The accelerated benefits provisions, also known as living benefits or terminal illness rider, allows an insured to accelerate the death benefit of a life insurance policy if certain conditions are met. Catastrophic illness coverage covers only identified or listed diseases in the policy, such as cancer, heart disease, renal failure, stroke, etc. The long-term care rider will generally pay benefits when the insured cannot perform at least 2 activities of daily living, ADLs. Activities of daily living, ADLs, include eating, dressing, bathing, toileting/continence, walking/ambulation, transferring or taking medication, There are two different ways a long-term care rider approaches: generalized or independent approach, integrated approach. An insurance dividend is not considered to be taxable income. A policy that provides a choice of dividend options must include a statement that dividends are not guaranteed. Dividend options include cash, reduction, or suspension of premiums, paid-up permanent additions, one-year term insurance, accumulated interest. One of the unique features of a life insurance contract is the ability for the applicant, usually the policy owner, to customize the policy to meet their specific needs through policy add-ons known as riders. The waiver of cost of insurance rider, also be referred to as the waiver of monthly deductions, is typically reserved for universal whole life policies. The disability income benefit rider provides an income benefit if the insured is totally and permanently disabled as defined by the policy. Policies that pay a multiple of 2 times the policy face amount are called double indemnity, and those that pay 3 times the death benefit for death due to accidents are called triple indemnity, and so forth. The death benefit paid under accidental death coverage is called the principal sum. The severance, dismemberment, benefit paid under accidental dismemberment is called the capital sum and is usually 1/2 of the principal sum. Guaranteed insurability option allows a policy owner to purchase additional life insurance coverage at specified dates without providing evidence of insurability. Payer rider may also be referred to as the payer benefit provision or payer clause, and is only added to a policy an adult purchased to cover the life of a child. Term insurance riders were created to give insureds an inexpensive option to add additional temporary coverage to a permanent policy. A level term rider adds an additional fixed, level death benefit for a predetermined amount of time at a predetermined cost to the existing face value of permanent policy. A decreasing term rider adds an additional decreasing death benefit for a predetermined amount of time at a predetermined cost to the existing face value of permanent policy. An increasing term rider will allow for a greater amount of coverage each year. Increasing term riders provide an additional term insurance face amount at death, equal to either all premiums paid or the amount of cash value. Cost of living rider automatically increases the face amount of the policy at specified intervals based upon increases in the Consumer Price Index, CPI. Riders can be added to a life insurance policy that provide term insurance coverage for the spouse, children, or entire family. The exchange privilege rider, also known as the substitute insured rider, outlines the conditions and processes for changing the insured of an insurance policy. The war exclusion prevents an insurer's financial catastrophe and typically applies to declared and undeclared wars. The status war clause is a restrictive type of clause which states that the insured will not possess coverage under an individual life insurance policy while he or she is in the military, even if killed while away on furlough. The results clause states that an individual policy does not provide coverage if the insured dies while participating in military activities or during military maneuvers of some sort. Most life insurance policies will exclude deaths that result from certain types of high-risk aviation activities.